Hi class, a pleasant day to all of you. This is your Professor Dan, and in this lecture video, we are going to discuss the module on additional equity transaction regarding treasury stocks. And our topic learning outcome is illustrate the accounting considerations on treasury stock. And our lesson explain the different transactions on treasury stocks with regards to purchase of treasury stocks, reissuance of treasury stocks, and retirement of treasury stocks. Let us start the discussion. What is treasury stocks? Treasury stocks are shares of stock which have been issued and fully paid for, but subsequently reacquired or bought back from shareholders by the issuing corporation either by purchase, redemption, donation, or other legal means. Okay? In the previous discussion, we have discussed donation, okay? And redemption is redeeming the stocks from the shareholders, and purchase is buying the shares from stockholders. Reasons for the purchase of treasury stocks. First, support employee stock compensation plans. If the corporation has a stock compensation plan, it means that the corporation would like the employees to be owners of the corporation by giving them shares. Okay? And second, improve the stock market price. And third, avoid takeover by an outside party because a shareholder has a vote. So if the stocks being held by other shareholders who are not part of the board member, then there is a possibility that these shareholders will take over. Limitations on the purchase of treasury stocks. The amount of the purchase of treasury stocks should not be more than the balance of retained earnings. Okay? So the amount that you will be purchasing from the shareholders with regards to treasury stocks, you have to look at the, the balance of your retained earnings. Okay? So the amount of purchase of treasury stocks should not be more than the retained earnings. So here let us illustrate treasury stocks. If the corporation has authorized share capital of 15,000 shares with 1,000 par value, okay, and the corporation made an issuance of shares to incorporators at 5,500 shares and to other shareholders at 6,500. So the total issued shares is 12,000. Okay, so this is the total issued shares. Take note, class, the reason why they are buying because the incorporators are the administrator or management. They are the management of the corporation, and there is a high probability that if these 6,500 other shareholders will pull together, they can take over the management of the corporation. Okay, so that's the reason why the corporation is buying shares from shareholders. Okay, so here in this case, of course, if you have issued shares of 12,000, that will also be your outstanding shares, meaning it is in the hands of the shareholder. It is on the hands of the shareholders. Okay, now the treasury stock is that the corporation will buy from the outstanding shares. Okay, it is called treasury because it is the custodian of this treasury stocks is the treasurer of the corporation. So if the corporation will buy 1,500 shares from the outstanding shares. Okay, and then there will be a deduction of the outstanding shares because this 1,500 will now be in the hands of the corporation. Okay, so here the outstanding shares will now be 10,500 because 1,500 is with the corporation. Okay, take note class, treasury stocks decreases the outstanding share and does not affect the issued shares. So outstanding shares is now at 10,500, but the issued shares remain at 12,000. And treasury stocks, okay, is the difference of issued shares with outstanding shares. Okay, so in this case, uh, 1,500 is equivalent to 12,000 minus outstanding shares of 10,500. This is important, class, because you can determine treasury stock even one of this is missing. Okay, in classroom problem you will be given uh, problems wherein you have to compute outstanding share or issued share or treasury stock by doing a transposition. Okay, so you have to take note of this equation. Okay, class. So the treasury stock transactions, the first one is the purchase of treasury stocks. The purchase of treasury stock is buying stocks from shareholders by the corporation, thus decreases assets and total shareholders' equity. Because the pro forma journal entry for the purchase of treasury stock is this: debit treasury stock, so the account being used is treasury stock, and credit cash. Okay, so when we debit treasury stock is an account under equity, and we have learned that the equity accounts are credit. Okay, to increase the equity we have to credit it. So in this case, treasury stock is a contra account of the equity, so it decreases the equity because it is being debited. So here in this case, the credit is cash because we are buying. Okay, the corporation is buying. Treasury stock is debited for the cost of the shares purchased. So the value that we will be debiting is this: the number of shares that we have purchased times the cost per share that we have purchased the treasury stock. Okay, we will do an illustration in the succeeding slide. Treasury stock has a debit balance because we are debiting and is reported as deduction from the total stockholders' equity. Okay, so it is a contra account of the stockholders' equity because it is a deduction. It has a debit balance. Treasury stock may be again reissued, sold, okay, for a price fixed by the board, or it can be retired. Okay, so this treasury stock that we have bought, we can reissue it. Okay, we can reissue or sell it to stockholders, or we can retire it, meaning we will not issue it anymore forever. For in definitely we will not issue it anymore. Okay, so here we have two options on the treasury stocks: whether we will reissue it, or meaning we are going to sell it again to shareholders, to the public, or we are going to retire it. Okay, meaning the corporation will just keep it. So let us discuss reissue. Treasury stock can be reissued, sold to shareholders even at less than par and no reference to par. We have learned that when stock has a par value, when we will issue it, it should be issued at par, or when we are going to sell it, we have to sell it at par, and or above par but not less than par. However, for reissuance of treasury stocks, we will no longer refer to the par value of that stock. Okay? Treasury stock is always credited at cost of purchase. So here, if we will reissue it, our credit is treasury stock. Here, when we purchase it, we debit treasury stock. So if we are going to sell it, this is what we are selling, this treasury stock. So here we are crediting it. Okay, so when we sell it, we will receive cash from our sales and then credit the treasury stock. But the value of this will be the same value or cost that we have purchased it. Okay, so if reissue price is more than the cost of treasury stock, okay, we will have a share premium from treasury stock. So we will credit treasury stock, meaning we will receiving more cash. So our credit here for the difference will be share premium treasury stock. If reissue price is less than the cost of treasury stock, okay, so it means that we will be receiving cash, a lesser cash. So our debit is share premium treasury stock or retained earnings. Okay, so here class we have we will just have to remove this one, share premium here. Okay, that will be our entry. Okay class, let us go back. Okay, now if the corporation choose to retire the treasury stocks, okay, it means that retirement of treasury stock means that it will no longer be reissued. It will no longer be sold to the public, okay? The treasury stock that we have purchased will no longer be sold. So in this case, the corporation will now have a reduced share capital because it will be permanently kept by the corporation. So retirement of treasury stock is permanently reducing the share capital. So our entry is we will debit now the share capital and credit treasury stock. Take note, class, when we issued, when we did an initial issuance of shares, we debit the cash that we received from the investors and we credit share capital. Since that we are retiring it, so we will now reduce our share capital and credit the treasury stock. The value of this treasury stock will remain the same, the cost that we have purchased the treasury stock. Okay? Retirement of treasury stock may result in a gain or loss from retirement. We will have an illustration on this. Okay, let us move on. So now class, we will discuss journal entries on purchase and reissuance of treasury stocks. Problem: the corporation has authorized shares of 15,000 with par value of 1,000 per share and has issued 12,000 shares. The company decided to purchase 1,500 shares at 2,000 per share. Okay. So here, the purchase of treasury stocks. Take note, class. We will be using the cost method. The cost method is the most common method. The other one is par value method. However, in this class, we will only be using the cost method. The cost method is that the amount that you have purchased the treasury stock, that will be the cost. Every time that we are going to debit or credit treasury stock, we will be using the cost of that particular treasury stock. Okay, so here, for the purchase of treasury stock, we will debit treasury stocks, and we have purchased 1,500 at 2,000, so that will be how we are going to calculate the amount of our treasury stocks. So that will be debit treasury stocks 3 million. And then we will, of course, give our cash because we are purchasing. So our credit is cash, same amount of 3 million. Okay? Now, we are going to reissue 1,500 shares of treasury stocks, the number of shares that we have purchased. We will now reissue it. So in this reissuance, we will have several situations. First, situation number one, we have sold 1,500 shares at cost of 2,000. So in this situation, we will debit cash of 1,000, meaning 3 million, which was computed 1,500 shares times 2,000 per share. That's 3 million, and credit treasury stocks of the same amount. Okay, this is for situation 1. For situation 2, if we are going to sell the treasury stocks higher than the cost, okay, this will be our entry. We will be debiting cash, which will be computed 1,500 shares times 2,500 because that's the amount that we are going to receive from the shareholder, from the buyer, okay, of our shares. And we will credit at cost still at 3 million, okay? We will credit at cost still at 3 million. So the difference will now be your share premium from treasury stocks, so 750,000. Okay? And for situation number 3, we sold 1,500 shares below cost of 1,800. Okay, so in this case, we will compute cash 1,500 times 1,800. That will give us 2,700,000. And our treasury stocks, we will record it at cost, which is 3 million. Okay, so the difference now, class, okay, this is how we are going to handle the difference. The difference is, or this is the rule. Rule in recording the loss. We have a loss here from the reissuance of treasury stock. First, we will have to see whether we have a share premium from treasury stocks before. And second, from if this share premium has already been exhausted or used, then we can debit retained earnings. Okay, class. Take note, class, by the way, this situation 1, situation 2, situation 3 are independent from each other because here we only purchase 1,500 shares. And situation 1, we have issued it the whole 1,500 shares. So situation 1 is independent from situation 2. And similarly, situation 1 and situation 2 is independent from situation 3. So in this case, we don't have any data that we could see that we have a share premium treasury stocks. So in this case, we don't have anything because this is a different situation, okay? So under situation 3, we will be using retained earnings because our assumption is that there is no balance in share premium treasury stocks. Okay, we cannot use this share premium here, which has a credit balance of 750,000 because this is an independent situation. So in this case, the 300,000 is debited to retained earnings. Okay, let us move on. Okay, class, we have seen these situations from the previous slide wherein we have purchased 1,500 shares of treasury stocks, okay? And then reissue this in different situations, okay? The whole number of shares that we have purchased, 1,500. Now, class, we will illustrate situations wherein there is a partial reissuance of the 1,500 shares of treasury stocks at different selling prices, meaning this 1,500 will be reissued in batches, okay, in several, probably it was reissued to different shareholders, okay? It was reissued to different shareholders. Okay, so we have here 400 shares from this 1,500. We reissued it at 2,000. 500 shares from this 1,500, we reissued it at 2,500. And 600 shares, okay, from this 1,500, we reissued it at 1,500, okay? Using the same data or given that the cost is 2,000, how are we going to handle this? Okay. First is that we sold the 400 shares at 2,000. So our entry will be we receive cash, which is computed at 400 times 2,000. So we receive 800,000. And of course, we will credit treasury stocks. And as I have said, we will use the same information from previous slide wherein we purchase treasury stocks at 2,000. So here we will have 4,000 times the 2,000 acquisition cost of treasury stocks, so we will have 800. So there's no difference because we reissued it at cost, okay? Now the second situation is that we sold 500 shares at 2,500. So we received cash and we computed cash 500 times 2,500, that will be 1,250, and treasury stocks 500 times 2,000 because that's the cost, our assumption, okay, which we will have 1 million. So in this, okay, there is a difference, okay. On the credit side, we are going to credit share premium from treasury stock amounting to 250,000. So situation 3, we sold this 600 shares at 1.5. So our cash is 600 times 1.5. That will give us 900. And we are selling the treasury stocks, and the cost of our treasury stocks is 600 times 2,000. So we have 1,200. So there is a difference. So we have now first to debit. Okay. Here, our rule is that we will have to exhaust first the share premium from treasury shares. Here, our difference is 300,000. We have here now the share premium of 250. From previous slide, the situations 1, situation 2, situation 3 are independent from each other. But in this illustration, all of this issuance, okay, re-issuance of shares is part of this 1,500 shares. So they are related with each other because they were purchased but at the same time with the same price, okay? So when we did the reissuance, one of the reissuances generated a share premium from treasury shares. So here we can debit share premium treasury shares of 250,000 with this, following this rule, okay? And 250,000, still not enough because there's still a difference of 50,000. Then based on this, that's the time we can debit retained earnings. Debit retained earnings at 50,000. Okay? Let us move on. We have some more here. And now we are going to discuss retirement of treasury stocks. We have this illustration. Now this is now a different illustration class for the retirement of treasury stocks. Okay. The corporation has the following: issued shares 50,000 at 10 par value, so that's 500,000. Share premium 60,000. course, this 60,000 is for this 50,000 issued shares. Case 1. The company purchased 5,000 shares at 13 from stockholders and immediately retired the shares. So first, we have to record the purchase. So the purchase is that we will debit treasury stocks, and so we have to record the journal entry for the purchase of treasury shares. We will debit treasury stocks. How are we going to compute it? Always at cost. 5,000 times 13. Okay, and that will give you 65,000. And now, credit. Since you are purchasing, you will have to credit cash. Credit cash, same. That is what you have paid at 65,000. Now here, it says that immediately retire the shares. So the journal entry for the retirement is that retirement means you are not selling it anymore. Retirement means that the company is keeping it. Okay. So what will be reduced is the share capital. You are retiring this, so you have to credit this. You have to zero this out, okay? Zero out these treasury stocks. So you have to now reduce your share capital. Your share capital, by the way, will have to be based on the par value because that is the way you have recorded it, based on the par value. So 5,000 times 10, so that will be 50,000. And you are retiring these treasury stocks, which you have purchased at 65,000. So you have to credit the whole amount of 65,000. So now there is a difference. Okay. Here, class, the rule for the retirement is slightly different with regards to the rule on the reissuance. There is, here you have to, retirement of treasury stock may result in a gain or loss from retirement. And the rule in recording loss is now, you have first to consider now the share premium from issuance, which we did not consider on the reissue situation. Here for the retirement, we will now consider the share premium from reissuance if there is a loss. Okay, and next, the share premium from treasury stocks and retained earnings. 2 and 3 is the rule for the reissuance, okay, if there is a loss. But for retirement, we will first to consider the share premium from reissuance, meaning this share premium. Okay. So class, how much is the share premium actually? So here we are going to credit the share premium, but we have to compute. The share premium is this. 560 because we have to now to determine the issue price. So the issue price is that the total 560,000 divided by 50,000. So here we have the issue price for this stocks is 1120 with a par value of 10. So the premium, the share premium from issuance is 120. So here the share premium is 5,000 times 120, okay, because this is what we have just retired, 5,000. That will give us 6,000. So there's still a difference, okay? There's still a difference of 9,000. Okay. The problem did not indicate that we have generated any share premium from this. So here, we don't have any share premium from treasury stock. So we cannot use this as a debit. So what we can debit is next is the retained earnings, which is the difference. Okay, so this will be our entry. Okay, class, and next situation is this. Purchase 12,000 shares at 8. So this the same illustration, but in this case, we purchased 12,000 shares at 8 from stockholders and immediately retire the shares. So let us record first the purchase of treasury shares. So we will have here treasury stocks Our entry, which is 12,000 times 8, will give us 96,000, and credit cash of 96,000. And now we will do the retirement. Okay, so we will retire. So when retiring, we are going to debit the share capital. The share capital will be computed 12,000 times 10. That will give us 120,000. And this treasury stocks, this is what we are going to retire. So we are crediting treasury stocks at 96,000. So there's a difference. So for the credit, there is no other way but to all record that as a share premium from treasury stocks. Take note, class, this rule is only for the loss. When it is share premium wherein there is a gain, it will all go to share premium treasury stock. Not retained earnings, not share premium from issuance, but share premium from treasury stock. Okay? Okay, class, that's it. And have a great day. Bye for now. And if you have questions, please let me know.